Hello everyone, today we'll be carefully examining every expense component in relation to the major solar energy project that Amazing Connection Limited chose to embark on. Our main goal is to try by all means to try and optimize HEC's benefits while upholding to the legal requirements, which will try by all means to support the business's long-term growth and operational stability. Firstly, we'll look at the purchasing of the panels. The purchasing of the panels qualify to be deductible when calculating the normal tax liability. Firstly, we'll look at Section 11A and what it says. It says that it must be an expenditure, it must be incurring of a trade, it must be in production of income, it must be actually incurred, and it must not be of a capital nature. This expenditure fails to comply with the requirements as it is seen as a capital in nature, as the asset is seen as an income generating structure as opposed to an income earning activity. This was derived from the case law of Rain Mines Limited, VCIR case law. Hence, this asset will experience a deduction under Section 12BA, which is 125% of the asset's cost, provided that the supporting structure and foundation is integrated to the asset and the useful life of the supporting structure and the foundation is equivalent to the asset's useful life, the cost of the asset. And then we're going to move on to the installation costs. The installation cost is more or less the same with the accounting accountability. This is referenced from Section 12BA1, which stipulates that the foundation and structure of the asset or improvements made to it should be integrated to the asset's cost, which generally means that the cost of the installation will be integrated to the cost of the asset. So the capitalized amount, we will capitalize the amount of installation, meaning that all the capital allowances allowed in the purchase price of the asset will also apply in the installation. Thank you.
Good day. Today I'd like to speak about purchasing of balancer systems and obtaining a permit. Amazing Connections will need to acquire a balancer system for the solar panels to function effectively. The balancer system includes electrical components, inverters, and mounting structures with an estimated cost of 10 million rand. The balancer system components will be classified as capital assets used in the production of income. Consequently, capital allowances include wear and tear allowances and the special allowance for renewable energy. Wear and tear allowance. The South African Income Tax Act allows for the depreciation of capital assets over their useful life. Special allowances for renewable energy. This allows for an accelerated depreciation. This allowance is according to Section 12B of the Income Tax Act. For solar photovoltaic systems, which includes the balancer systems components, the tax deduction can be claimed over a 3-year span, 50% in year 1, 30% in year 2, and 20% in year 3. The amended Section 12BA allows taxpayers to claim a deduction of 125% of the qualifying cost of assets that generate power from sources like wind and hydropower, solar energy, photovoltaic solar energy, and biomass. The Act requires a certain criteria to be met in order for a taxpayer to receive a deduction of 125%. These are: the assets must be new and unused, the asset must be used in the production of income, the business must own the asset, the business must be registered for corporate income tax. And in conclusion, all the criteria are met with regards to all of the capital allowances mentioned above. The option which is most beneficial to the company is that of Section 12BA of the Tax Act, and that should be applied. As a result, 12,500,000 will be deductible in the current year of assessing a permit. With regards to obtaining a permit, Amazing Connections would have to acquire a permit from the government at a once-off cost of 750,000 rand before commencing with installation. We'd have to determine whether the permit will be deductible for Amazing Connections' taxable income. Two key elements of Section 11A to consider: incurred in the production of income and not of a capital nature. It is evident that the permit is capital in nature for the following reasons. The cost of the permit is a preliminary expense that must be incurred before the commencement of the panel installation. This type of expenditure is typically viewed as a preparatory or initial cost, which is generally capital in nature. And point number 2. The permit is a regulatory requirement that grants Amazing Connections the right to proceed with the installation. As such, it is part of the initial setup cost and is associated with creating a capital asset. Expenditures that provide an enduring benefit or are necessary to bring an asset into existence are considered capital in nature. Ultimately, as the permit is capital in nature and has more to do with the income producing structure than the business's revenue producing structure, it does not fall under Section 11A.
Good morning. I'll provide an overview of the inspection and maintenance cost for our project. The inspection cost estimated at 1.5 million are capital in nature as per BPSA versus Commissioner for SARS. These costs are associated with creating or enhancing a capital asset and are not deductible under Section 11A of the Income Tax Act. They must be capitalized and depreciated over time, affecting our short-term tax liabilities. Additionally, no allowances under Section 12BA apply, as these costs do not meet the criteria for renewable energy assets. We have two categories of maintenance cost. Minor maintenance cost of R10,000 deductible under Section 11D for repairs, expenses incurred for purposes of trade within the year. Major maintenance cost of R50,000 per year deductible under Section 11A as recurring operational expenses incurred in the production of income. In summary, 1.5 million inspection costs are capitalized. R10,000 minor maintenance costs are deductible under Section 11D. 50,000 annual major maintenance costs are deductible under Section 11A.
Good day. Today I present an overview of our company's tax implication regarding insurance cost and acquisition for battery power backup system. Under South African tax law, insurance premiums safeguarding business assets such as solar panels are typically deductible under Section 11A of the Income Tax Act. The premiums must be deemed ordinarily and essential expenses supported by case law like sub-nigel. Insurance proceeds are taxable income surpassing deductible premiums but not be taxable if used for asset replacement. The purchase for battery power backup system is a capital expenditure, capitalized and depreciated over its useful life. Assuming 5-year useful life and straight line depreciation, annual depreciation expense amount equals to 1,290,000. Investing in battery power backup system enhances operation robustness, mitigating power fluctuation. It's vital step towards ensuring a long-term success for Amazing Connection. Thank you.